What is money? A journey through time. What if I told you that the paper bills in your wallet, the numbers in your bank account, and even cryptocurrencies all exist because humans agreed to believe in something called money? Money shapes our dreams, careers, businesses, and even entire civilizations. Yet, most people use money every day without ever asking a simple question: what exactly is money? Today, we are ta- taking a fascinating journey through time from seashells and cattle to gold coins, paper notes, credit cards, and digital currencies to discover how money evolved and why understanding it may completely change the way you think about wealth. Let's begin. Point number one: money started with barter. Long before banks existed, people exchanged goods directly through a system known as barter. If a farmer had wheat and needed shoes, he had to find a shoemaker who also wanted wheat. This system worked in a small communities but quickly became difficult as societies grow larger. Barter suffered what economists call the double coexistence of what wants. Both parties had to want exactly what the other offered at the same time. Imagine trying to trade your laptop today for groceries. Finding someone willing to accept the trade would be challenging. As civilizations expanded, people realized they needed something universally accepted to simply simplify exchanges. For example, a fisherman with 10 fish could exchange them for rice only if the rice farmer wanted fish. If not, the fisherman went home empty handed. Next point number two: the first forms of money. Different societies began using items that everyone considered valuable. These early forms of money included cattle, salt, tea levels, shells, beds, and even large stones. These objects served as mediums of exchange because communities trusted their value. In fact, the word salary comes from the Latin word salarium, since Roman soldiers were sometimes paid with salt. However, many of these items were difficult to transport, divide, or store safely. Let's say example, on the specific island of Ape, enormous stone disc weighing several tons were used as money. Ownership changed hands even though the stones rarely moved. Next point number three: gold and silver changed everything. Precious metals eventually became the preferred form of money because they possessed important qualities. Gold and silver were durable, portable, divisible, and scarce. Governments began minting standardized coins to guarantee their purity and weight. This innovation boosted trade, encouraged economic growth, and connected distant civilizations. Gold coins become symbols of power and prosperity, enabling merchants to conduct business across kingdoms. Example: a merchant traveling from Europe to Asia could carry gold coins and confidently purchase goods because people widely trusted their value. Next point number four: the birth of paper money. Carrying large amounts of gold was risky and inconvenient. Merchants started depositing their gold with a trusted goldsmith and received paper receipts in return. Over time, people realized that these recipients could be exchanged directly for goods and services. Eventually, governments adopted this concept and issued official banknotes. Paper money was lighter, easier to carry, and made commerce more efficient. Example: instead of transporting 20 kilograms of gold for a business transaction, a trader could simply carry a piece of paper representing that value. Next point number five: why money works. The power of trust. Money has little intrinsic value today. $100 bill cost only a few cents to produce. Yet millions accept it because they trust the system behind it. Economists describe money through three essential functions. It acts as a medium of exchange, a store of value, and a unit of account. Without trust, money loses its usefulness. History has shown that when people stop believing in a currency, inflation can spiral out of control. Example: if everyone suddenly refused to accept a country's currency tomorrow, people would immediately seek alternatives such as foreign currencies, gold, or goods. Next point number six: banks became the guardians of money. As economics expanded, banks emerged to safeguard deposits, provide loans, and facilitate payments. Banks discovered they could lend out a portion of deposited funds while keeping reserves for withdrawals. This process fuels business investments, home purchases, and economic growth. Modern banking transformed money from something physically stored into numbers recorded electronically. Let's say example: when someone deposits $1,000 into a bank, part of that money may be loaned to a small business owner opening a cafe, helping create jobs and economic activity. Next point number 7, plastic money and digital banking. The late 20th century introduced credit cards, debit cards, and online banking and mobile payments. People no longer needed cash for everyday purchases. Transactions could occur instantly across continents with a few taps on a smartphone. Digital banking offers convenience, speed, and security, although it is also increases concerns about cybercrime and privacy. Example: a student in India can purchase an online course from an instructor in Canada within seconds using digital payment platforms. Next point number 8, cryptocurrency, a new experiment. In 2009, the world witnessed the arrival of cryptocurrencies, beginning with Bitcoin. Unlike traditional currencies issued by governments, cryptocurrencies operate on decentralized blockchain technology. Supporters believe cryptocurrency can reduce transaction cost and increase financial independence. Critics point out challenges such as price volatility, regulation, and energy consumption. Whether cryptocurrencies become mainstream or remain niche assets, they all have already sparked an important conversation about the future of money. Example for this: someone who purchased a Bitcoin for a few $100 in its early years saw its value rise dramatically, while others experienced significant losses during market downturns. Next point number 9, the future of money. Money continues evolving rapidly. Central banks are exploring digital currencies while AI is reshaping financial services. Biometric payments, programmable money, and instant international transfers may soon become commonplace. Future generations might view physical cash the same way we view ancient seashells, interesting historical artifacts rather than everyday necessities. Let's say example. Imagine entering a store, selecting products, and simply walking out while sensors automatically detect payment from your digital wallet. Point number 10, the greatest lesson about money. Despite all its transformation, money itself is merely a tool. It amplifies human decisions, values, and priorities. People who understand how money works tend to make better financial choices, build wealth steadily, and avoid costly mistakes. Wealth is not determined solely by how much money someone earns, but by how wisely they manage it. The history of money teaches us one profound truth: societies prosper not because money exists, but because people trust systems, cooperate, and create value together. Let's say example, two individuals may earn the same income. One spends everything immediately while the other saves, invests, and learns financial skills. Over time, their financial futures can look completely different. Next, money has traveled an incredible journey from cattle and shells to gold, paper, notes, smartphones, and cryptocurrencies. But perhaps the most fascinating discovery is this: money has never truly been about paper, metal, or technology. It has always been about trust, human cooperation, and the belief that tomorrow can be better than today. If you enjoyed this journey through the history of money, don't forget to like the video, subscribe to the channel, and turn on notification. And tell us in the comments, do you think physical cash will disappear completely in the future? Thanks for watching, and I will see you in the next video.